Hi everyone, welcome to IBKR Podcast. My name is Elizaveta Gridneva. Tonight we will talk about Japan with Nicholas Ng, head of APAC Wealth from Daiwa Asset Management. Hi Nick,
Hi, Lisa. Thank you for having me on this episode.
thank you for joining. So, big changes in Japan. Tsunai Takaichi became prime minister in Japan, which was accepted very well by stock markets and also by people in Japan. Expectations are high. She's expected to increase government spending, ease inflation pressures, and improve life of ordinary people. So, the first question for you tonight, Nick, do you think she can deliver promises given before elections? What is your outlook in general for Japanese economy under her leadership?
Yeah, thank you very much for the question. I think generally when it comes to elections globally, a lot, typically politicians tend to overpromise and underdeliver. However, in this case, and given the culture in Japan, from the outset, it does appear that she should be able to deliver most of her promises. And it's interesting to note, I mean, the previous LDP leadership had a minority. So typically when they were looking to implement any policies, they may face some hurdles. However, now that she's won the majority, it should theoretically be a lot easier for her to get her policies through. So I think in short, she should be able to achieve most of her promises.
That's great. And next, I think I would like to ask you about rates in Japan. So Bank of Japan kept rates unchanged in October meeting. There is expectation that it will hike in December. Is that also your expectations? And do you expect Bank of Japan will continue rates normalization process next year too?
Yeah, in terms of interest rates in Japan, I mean, our house view is the BOJ may hike one more time this year. So, that would be in December. However, looking at the overnight index swaps market, it seems to be that the highest probability of a rate hike will likely be in January 2026. I think from the previous BOJ meeting, they were still concerned about the impact of tariffs and how that may impact the Japanese economy. So it seems they're still watching what's happening, but yeah, it's likely. I think it's probably likely to happen in January 2026.
Understood. And just understood. And just taking one step back. So now Japan is an yeah. Just taking one step back, so Japan looks to be on investors' radars for the last few years. Historically, why do you think investors not pay much attention to Japan?
Yeah, I mean, historically, investors haven't really paid much attention to Japan, just given that the economy has been in deflation for the last 2 to 3 decades, and given that the economy has been in deflation, it's just meant there hasn't been much growth, if any, whether it's economic growth or corporate earnings growth. And I think that's why investors haven't paid too much attention. And, if many investors aren't paying much attention, they may think of Japan, stuck in the 1990s or early 2000s, and they may only think about a Sony Walkman or a Sony Discman. They may think about household appliances from Sony or Hitachi. That could be like a fridge or microwave or TV. And, it could be like autos, for example, just cars. And it's interesting to know when it comes to equity investing, when you look at the MSCI All Country World Index, which is a global equity benchmark, the US makes up the highest country weighting at around 63%. And surprisingly, Japan makes up the second largest weighting at close to 5%. So when equity investors around the world allocate to Japan, a lot of equity investors tend to be underweight Japan. And that's slowly changing where investors will start to allocate to Japan and, over time be equal weight and start going overweight to Japan going forward.
Yeah, that's interesting fact to know. So you're thinking that it will change, and what's the reason behind why people finally are interested in Japan now? What has changed? And I think our listeners would like to know what are some of the structural drivers supporting the economy and stock market.
Yeah, sure. So in terms of the changes, I think there are probably 3 to 4 reasons or the biggest drivers to why the economy is changing. The first one is normalization or interest rate normalization from the BOJ. Given that inflation has started to pick up in the last couple of years, this has obviously meant interest rates should also increase. And Japan has exited decades of deflation to move into inflation. So I think this is one of the biggest drivers. The next area is the Nippon Individual Savings Account, or NISA for short. In Japan, this NISA account acts like a tax-free savings account, similar to the Roth IRA in the US or the ISA in the UK. And it's interesting to know for Japan, around 50% of households have their cash or investments in cash. And as interest rates start to rise, obviously they need to start moving their cash into risk assets. So when money flows into these NISA accounts, which are tax-free accounts, the money tends to flow into Japanese stocks and mutual funds as well as global investment. So I think that's another driver. And I think the third driver is corporate reforms. Given that Japan has been in deflation or a deflationary environment for so long, a lot of corporates have been hoarding cash and haven't really been spending on capital expenditure, capex, and growth projects. So they've been hoarding a lot of cash on their balance sheets. What this does is it makes their valuations a lot lower than what they theoretically should be. And their price to book ratios or return on equities may be, I guess, artificially depressed. Now, the Japan Stock Exchange has said over the last couple of years that if your company listed on the stock exchange is trading at less, for example, less than 1 times price to book ratio or a low return on equity multiple, there is a potential that we will delist your company. And obviously, a lot of these companies don't want to be delisted. So they have two potential options. One, they can potentially buy back their own shares with that cash on their balance sheet. And with that cash, it's essentially buying back their own shares, less shares outstanding, the stock price theoretically should go up. Or two, they can pay a higher dividend, which is good for shareholders, or a combination of both. So these are some of the structural drivers. And just lastly, is the unwinding of cross shareholdings. In Japan, cross shareholdings is a relatively unique practice versus the rest of the world. And this essentially means that a company, for example, let's just take a bank, takes a stake in an auto manufacturing company. And the reason why they would do this is because it's a soft way to cross-sell their products. So for example, the bank may be able to cross-sell their loan products to the auto company, but also it's for the corporate management team of the bank as well as the auto company to work together, protect their own interests from external shareholders. And given that cross-shareholdings are starting to unwind, it just means, for example, in this example, the bank is unwinding their shareholdings and selling their stake. They can use that cash for something more efficient and more productive. So, there are a bunch of reasons why Japan has been gaining more interest from investors recently.
That's great. Thank you for the detailed answer about the structural changes. So, what are the main investment themes currently in Japan, and what investors should pay attention in the future?
In terms of investment themes, I think we could probably break it down into 3 areas. The first area is going to be structural reforms, similar to what I shared earlier. So investment themes could be interest rate or BOJ normalization, where as interest rates rise, banks and financials tend to do well. It could also be corporate reforms, and low valuation companies will do well when they buy back their own shares or have dividend hikes. Another area is global megatrends. And when it comes to global megatrends, this could be, for example, the AI sector. So there are some companies within Japan that also benefit from the AI sector. There also is defense. So given that global defense stocks around the world have done very well over the last few quarters, Japan also has interesting defense manufacturing companies, and also autos and robotics and automation. And I think that the last area or themes which are of interest to investors could also be unique plays or themes to Japan. So this could be, for example, entertainment and intellectual property. So Japan is known for games and anime. It could also be Warren Buffett's favorite trading houses, which a lot of investors tend to look at. And just one more thing to add on what else investors should look at for Japan. Typically, when investors look at Japan, Japan tends to be a fundamentally driven market as well as a style driven market. And every market around the world is slightly different. So, for example, if you're in the US or Europe, generally the stock market is fundamentally driven. Whereas if you're looking at Hong Kong, China markets, the equity market may be driven by news, macro sentiment, which drives equity prices. For Japan, it feels as if style tends to be one of the biggest drivers. And, you might be wondering, what do I mean by style? Style, it could be value names, so companies that trade at low valuations, or growth names, companies with high earnings growth. And the reason why style is important in Japan is because Japan has a fair amount of large cap exporters. These are essentially companies that export their products globally. So, you could think of Sony or a Hitachi or a Toyota. And if the Japanese yen weakens over time, when these companies sell their products overseas and they bring their money back to Japan, obviously this company will have higher profits. And conversely, if the Japanese yen strengthens, when these companies bring their money back to Japan, it would be less. So movements in the US dollar JPY exchange rate does impact the style quite a lot within the Japan. When investors do look at Japan, it's important to look at US interest rates as well as interest rates within Japan, because currently we are in a value market in Japan, and we've been in this market for the last 5 years. But prior to that, we were in a growth market, which lasted for about 4 years. So the cycles do change, but what's really been driving this value cycle in Japan for the last few years is not just structural reform in Japan, but it was interest rate hikes in the US. And I think when this started in 2020, around there, this has really fueled the value market. So theoretically, if US interest rates trend lower over the next few years, then the growth market should come back. However, one big difference is that Japanese interest rates are not pinned to zero and are able to freely fluctuate, which may ensure that the cycle is not 100% the same as the previous cycles.
Thank you, Nick, for this overview. And now moving on to some practical applications. So, for example, if someone new to investing into Japan, what are some simple strategies to gain exposure to Japanese market?
Typically for new investors, if they're looking to invest into Japan, usually the most common way and the easiest way is to invest into an index or an ETF. And these usually are the topics in ETF or index, because this just gives you broad market exposure without having to know too much about the underlying stocks. Another way to invest into Japan is you can simply buy your favorite stocks. And when it comes to foreign investors, including myself, most foreign investors tend to invest into large cap exporters. They may also invest into blue chip names, which they see on the TV quite often, or they may even copy trade Warren Buffett's favorite 5 trading houses, which seems to be one of the most popular trades over the last couple of years. In addition, investors also do invest through active funds. And the reason why some people may invest into active funds is, they think the active fund could potentially outperform the index. So A practical way to do it is if your view is the value cycle will continue to go, you would probably invest into an active value fund to ensure that you could gain some sort of alpha or performance advantage over a typical index. And I think this is most likely a momentum chasing theme. Conversely, if one's view was that they thought the value cycle, we were late into the value cycle and we may rotate into a growth cycle, then you may position into growth to play that bet. However, selecting a style in Japan is not always easy, as it's difficult to time. So what many investors do is they would look for a blended or a style agnostic approach. And this would ensure that they wouldn't be caught off guard in case the style moved against them and they could still wanted some potential upside or performance advantage over a typical index in Japan. So these are the most common ways that investors will gain exposure to Japan.
Thank you. That's very insightful. And if we speak about some of more sophisticated strategies, do you have any unique insights for us?
Sure, yeah. So just adding on to the typical strategies which I mentioned earlier, nowadays investment managers and fund managers are becoming more sophisticated, and there are a few interesting ways or strategies that fund managers gain exposure to the market. One way is through a systematic or a quantitative approach, which has been gaining popularity globally. This is essentially where a fund manager would invest into Japan following a quantitative or systematic screening model. It could be rules-based. It could be a multi-factor model where they would use quantitative metrics to determine the stock selection and the weights every month or every quarter with minimal human interaction. The second way is through a hedge fund style strategy. This has started to gain quite a bit of popularity recently, just given that equity markets are at relatively high levels, and investors like these type of strategies because that if there is some sort of downside, the downside for a hedge fund strategy may be slightly less, but they're still able to capture some sort of upside gain. And usually this is through a long short strategy or a market neutral strategy where the fund manager will be long single stocks, and they will also be short single stocks known as pair trades. And, it's one way to lower the volatility or potential drawdown, but still capture some of the upside. And the third way, which we've been hearing a lot more about recently, are activist strategies, otherwise known as engagement strategies in Japan. Your typical long-only strategy in Japan is usually when a fund manager would buy a stock and they would wait for the corporate management team to do something. With an engagement strategy or an activist strategy, the fund manager would essentially identify, for example, an underperforming company. They would strategize a potential solution. They would propose that solution to the corporate management team, and then they would see if they're able to work with that corporate management team over the next few years to improve shareholder value and increase shareholder returns into the medium to long term. So this strategy tends to have lower downside because the underlying companies have been poorly performing or mismanaged. So the fund manager feels that they may be able to potentially add value. So these are some more sophisticated strategies which investors have been looking at today.
Thank you, Nick. That's great. I really enjoyed discovering Japan today with you.
Thank you very much for having me, and I look forward to joining another episode in the future.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice. There is a substantial risk of loss in foreign exchange trading. The settlement date of foreign exchange trades can vary due to time zone differences and bank holidays. The interest rate on borrowed funds must be considered when computing the cost of trades across multiple markets. Any discussion or mention of an ETF is not to be construed as recommendation, promotion, or solicitation. All investors should review and consider associated investment risks, charges, and expenses of the investment company or fund prior to investing. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice.